Welcome to this week's video. Today we will be going over some technical and psychological traits holding a lot of you guys back from inconsistent results. So without wasting any more time, let's get straight into the video.
So the first negative trait that I see in a lot of inconsistent traders is greed and impatience within their executing, right? So the reason this is an issue is because it leads them to over risk and over trade, which then leads to inconsistent loss patterns. Now to fix this, we can implement a risk management plan. Now this is going to look very different for different people and based on different trading styles. Now all of you guys should have a daily loss limit and a max risk per trade. I know if you guys are using prop firms such as TopStep, they have ways to implement a lockout system for your accounts. Now, if you're trading live capital, it's going to be really, really crucial that you guys are implementing these tools because it's easy to burn through money quickly and see yourself revenge trading. Now, for me in my personal trading, I trade a very high risk reward system, which means that I'm typically risking around 10 points on NASDAQ. So for one contract, that would be $200. And my risk reward is typically around, a 10R, which is going to be risking $100 to make 1,000, right? Now, me as someone who trades a live account, having this high risk to reward is very, very crucial to keeping me alive as a trader. I know a lot of you guys are focused on profitability and you want to win as many trades as possible. You're focused on winning big, but that's not what makes a trader consistent. What makes a trader consistent is mitigating any losses, right? So by having a high risk reward system, right, I'm rewarded more for my wins and punished less for my losses. Um, so yeah, this is really going to help with periods of losing streaks, which if you trade and you're in the market for a long amount of time, you will inevitably go through losing streaks. And so the way that I'm able to trade and my system allows me to, like I said, have this high risk reward system. Now, another thing that's going to be crucial for risk management is your stop loss placement and setting stop loss. Now, there are certain ways you can go about this. For example, like moving your stop to swing highs and swing lows, which we will show you on the chart. And there's also ways to protect capital, such as going break even, which we'll show you how to do right now. Okay, so here we're looking at an example from last week, Thursday, October 16th. And I'm going to run you through how I would have gone about placing my stop loss on this day. So we had this price delivery lower here off of this standard deviation level, and we see that we had this inverse gap. Now we called out shorts off of this change in the state right here to deliver lower. Now for this, the valid stop loss would be above this swing high created right here. So you guys saw I was talking about swing highs and swing lows. This would be a valid swing high because considering that price delivery is bearish here, this high right here should remain protected and should not be revisited, meaning that within this range, price will trade lower. Now, once we see price trade through this internal swing low right here, and we see price closes through it like this, that's when I'll move my stop loss down to break even. And there I have a protected position, right? Now, when price comes and takes out this next draw on liquidity right here, this low, we see price retraces into this fair value gap and it creates a new protected swing high after trading lower. So after we see that price makes this high, trades lower, and closes through this low again, we can now trail our stop loss down to this high. So our stop loss will be trailed to there, and we can continue to do that. After we trade into this fair value gap and create this high, we can trail even further, and we can do that to protect capital and secure capital on the table all the way until we hit our final draw on liquidity for the day. So yeah, super kind of simple way there of how I'm going about reading where my stop loss should be. Another way you might want to place stop loss, which is for entering off of levels, is going to be just using a consistent 10-point stop loss. So let's just say that you wanted to enter off of this negative 2.5 deviation or this negative 2 deviation. You would put a limit order there or wait for a reaction. So let's say you wait to see we're wicking out of this level you want to enter there, and you would just put a 10-point stop loss, and you would target your draws, and you would trail the stop in the same way, right? So trailing down from there to these protected highs along the way. But yeah, pretty straightforward, and it will really save you in the long run and help you achieve consistent results.
Coming back to the slides here, I want to talk quickly on a word that was brought up multiple times, which has a lot of meaning behind it. And that word is system. And what does it mean to actually trade a system? Most people look at a system or a model as the technicals or the chart or analysis and all that type of stuff, which is great. But you also, when you're thinking about system, you have to understand that risk management is a huge part in your system. It's very important to understand what model you're trading and what risk system fits that type of model. It could be something where your model forces you to go in with higher risk and tighter stops, or on the other hand, something where your model forces you to have wider stops and lower risk. And your job is to figure out what type of risk management system your model supports. And that's going to help you see the consistent results trading whatever model it is, because we all know that most models work. You have to trade it the right way though. All right, so moving on to the lower section of this slide, we have why traders struggle with patience. Number one, we have instant gratification bias. This talks about the dopamine a lot of traders feel from seeing the profits, the money fluctuate up and down quickly, big wins, all that type of stuff. But you have to ask yourself, is that truly following a consistent system, or is that more on the side of gambling? Yes, I don't like to say it too much, but there are a lot of people that do gamble as traders. Number two, fear of missing out, which is FOMO. We all know what that is. It doesn't take too much detail to go over it. Last but not least, overanalysis or boredom. This is where most people feel like sitting is wasted time and they want to be in active trades. You want to feel that, like I was talking about earlier, that dopamine. But this is one of those things that you just have to accept that it doesn't work when it comes to being a consistent trader. You have to understand that most of the time you are going to be sitting on your hands, sitting at the desk and not actively trading. It's going to give you a type of headspace where you're able to see those setups, and then you'll be taking those setups here and there when you do see them, but that's about 30% of the time. And that's just something you have to understand. You have to accept it. When you can overcome these struggles, you'll start to reduce impulsive losses as well as over trading, build confidence in your edge and setup criteria, strengthen your emotional resilience, and you have to understand that waiting should be comfortable, not stressful.
Now, going back to that word of system that Daniel mentioned, I want to talk to you guys about a lot of you not trading a statistically proven edge, right? So Daniel was talking more about the emotional side of systematic trading, and I'm going to talk about the technical side, right? Now, we know that if you have a proven edge in the market over a series of trades, you will be profitable, right? Now, a lot of you guys, the reality is you're not trading any statistically proven edge. You're not trading at something that's actually profitable. You're trading without structure, you're taking random entries, and most importantly, your entry models are inconsistent. You're taking completely different looking entries every day with different confluences, right? So a lot of you guys have analysis paralysis, right? You have studied up on all of your ICT's terminology. You know your breaker block, your fair value gap, your order block, all these different things, but you don't actually understand how to use them together, and you haven't put them into a consistent model. So you can fix this by starting to add things like an entry checklist, right, which we preach a lot and we have templates for, which we'll link down below. But another thing you can do is, let's say you start trading and you come to find a model that you start to like and you understand. What you should then do is, go on FX Replay, go on Chart Champs, some sort of backtesting software, and backtest a series of trades using this model and see what your stats are. See if the model you want to trade is actually profitable. And if it's not, you should, look to go somewhere else. And we here do have our own mentorship and teach the model that we have built and trade, but I'm not, trying to plug what we're teaching, but I do recommend that all of you guys do find some sort of mentor who has came up with their own statistically proven model that actually works, because you guys are going to be completely misguided if you're trying to take trades off of just your own intuition when you haven't been trading for long enough to really understand what the market's doing, right? So look for the same entry setup and entry trigger every single day. Make sure it's repeatable and consistent, and find what works for you, right? If someone else trades something, if you see that I'm trading a certain model and it makes no sense, you should not be taking those entries. You should be finding something that works for you.
So moving on into negative trait number 3, we're going to be talking about P&L identity crisis. This is basically where a lot of traders are tying their self-worth to their P&L. Whether they win or lose, it's going to affect how they feel or how they think about themselves. This creates a negative mindset where you're no longer trying to prove consistency or just grow as a trader, and instead you're trying to prove something to yourself, which in this case is not beneficial.
All right, so now let's get into why these triggers actually happen. The first one's going to be ego involvement. A lot of people associate their ego and their self worth with how they perform on the market. If they take a win in New York Open, they're going to be jolly and feel valued the rest of the day. If they take a loss, they're going to feel worthless and like a loser, as we've just said, right? And the reason that this is a horrible, horrible trait is because when you think about trading and what it is, it's statistical data and a profession, right? Now that should have zero impact on what you do for the rest of the day and how you are feeling for the rest of the day because they're completely unrelated things, right? Now the next one's going to be validation seeking. Trading becomes proof of an intelligence or your discipline levels, right? I see a lot of people who are younger in the space, maybe around my age, who go to school and they open up their laptop to TradingView so the people at school will see that they're a trader, right? And they want everyone to know that they're a trader. And it's more of a external validation and appearance thing than actually, mastering this skill and actually seeing profits and success from trading. Now, kind of tying into that is going to be social comparison. Obviously, we live in a day and age where social media is a big part of our lives. And obviously, me included, I'm posting my trades on social media. And so I see a lot of you guys will trade and then immediately open up TikTok or Instagram to see what trades everyone else took, right? And if you took a loss and you open up social media and you see everyone else is posting wins, you're going to crash out. You're going to feel like you're worthless. You're going to be like, what's wrong with me? Why can't I get it? Why is everyone else winning? And that's just going to fuck you over because ultimately trading is a very individual process. You don't want to be too involved with what other people are doing or what they have going on. You want to just be focused on you and the charts, right? That's all that matters. Now, the fourth thing is going to be the all or nothing mindset, right? Um, People are judging their entire skill set off of one trade. They're like, oh, if this one trade loses, I'm a horrible trader. I suck. What am I doing? They might crash out. They might full port because of this. They'll be like, oh, it doesn't matter anymore. And that's just going to cause a lot of mental decay, right? So all or nothing mindset, perfectionist mindset, that's not going to be something that's going to work in trading because, like I've said, it all comes down to probability and your results over a series of trades. One trade, 1 week of trading, even 1 month of trading really doesn't say much about you as a trader. It's about how you're performing over a long, long period of time.
So going off the triggers Jake just mentioned above, we're going to talk about detachment from the outcome. You want to be trading in a probability mindset and less of reacting to how the trade actually performs, whether it's a win or loss, whatever the case is. You are not your last trade. I see so many people start to have identity crisis or overreact to taking a losing trade when you have to understand that's just part of trading. You're going to take losses here and there. There's no model that has a 100% win rate. So the same thing, it can also lead into your confidence in that next upcoming setup you take. You might be a little less confident due to the last loss, and it's very, very, very important to just be able to move on. Talking about the win as well, some people get overconfident or cocky after taking a big win, which might not have been deserved. That can open up the mindset of being euphoric, and we all know what that leads to. Performance over person. You want to judge yourself on how disciplined and consistent you are with following your system, your model, whatever the case is, and less on your P&L. Most people rather end the day in a satisfying profit rather than following their system, following their rules on that day. And that's just not the type of trading mindset you want to have to see consistency. Talking about a neutral mindset, you want to have the same reaction to or win a loss by following the same routine. You log on for the day, if your setup presents itself, you enter, stop loss, take profit, let the trade breathe, and have a neutral mindset despite the outcome of the trade, whether it's a big loss, a big win, or even break even. You want to have a very neutral mindset, journal, log off, and move on for the day.
Now that we're coming into the closing segment of this video, we want to give you guys some practical steps to actually stop these mental hurdles that you guys are facing. So the first thing is going to be process-based journaling. Now, this is going to be not only journaling the loss you took, but also looking at the day as a whole and looking at the trades that you didn't take that you could have taken and also looking at your mental state as well as the technicals. So this is a holistic journaling process where you are identifying each step of your system and seeing where the issues are and what you are doing well that you can repeat in the future. Another thing you guys can do is a language shift. This is going to be big on the mental erosion and stopping that from happening when you are going through this process of trading, because as we know, there are going to be a lot of ups and downs, and you need to be able to be, accountable for the actions that you are taking. So instead of, blaming yourself and saying I was wrong, say this trade idea did not work out, and then figure out why it did not work out and be very analytical in your process there. And then moving on from that, we're gonna, be thinking in terms of batches and probabilities. So batch-based thinking. This is essentially going to be evaluating yourself on every, 10 to 15 trades, not solely on one trade. So the way that this shows up for me in my personal trading is I will do a journaling session for my week as a whole, and instead of, I do journal my trades every single day, but that's not where I'm doing my bulk of review. My At the end of every week, I'll do a, hour to 2 hour review session where I'm looking at the series of every trade I've taken and looking for similarities in the winners and the similarities of the losers, and adding that data into my model to make it even better. And then I'm doing the same thing on a monthly basis, which is looking at even more data, and I'm able to take the data that I had from those weeks of trading and put it all into a month's worth of data to then further refine my edge. So yeah, when you guys start to trade in this very, very systematic and business approach, it's going to allow you to really scale your trading to the next level.
If you guys like this lecture style content, we do a lot more in the free and premium Discord, which we'll leave a link below so you guys can check that out. If you have any questions on the topics we talked about today or any video content ideas, you can also leave a comment below. But with that being said, we will catch you guys in the next video.